Hello everyone. Today I would like to discuss one of the most confusing topics in accounting. If you are working in any organization dealing with money and having customers, then you want to understand it. If you are working with any accountant who is telling you every day, I will debit this account with X value, I will credit another account with Y value, and you start to think firstly, what does he mean? What does it mean firstly by an account, and what does crediting or debiting an account mean? You might think from the first instance that debiting an account is increasing its value and crediting an account is reducing its value. Surprisingly, this is not correct. If you want to know more and you want to understand this topic, let's dive in together. For us to understand that, we need to keep in mind one principle, which is the double entry accounting principle or concept. The majority of business firms worldwide rely on the double entry system, even though they are more complex and more difficult to use than the more straightforward alternative, which is the single entry system. Using a double entry system requires at least some level of formal training in accounting. The user must, for instance, have a solid grasp of concepts such as debit, credit, chart of accounts, and the two accounting equations. By contrast, just about anyone who has or can arrange numbers in a table and add and subtract can set up and use a single entry system. All public companies and almost all large firms choose the double entry approach. They choose double entry accounting because it's nearly impossible for them to meet government and regulatory requirements for reporting and for record keeping using a single entry system. And with a single entry system alone, large firms cannot accurately track their assets, liabilities, equities, revenue, or expenses. Double entry accounting is a standard accounting method that involves recording each transaction in at least two accounts, and we will define later what do we mean by account, resulting in a debit to one or more account and a credit to one or more accounts. But at the end, the total value of credits shall be the same value for debits for the same transaction. And remember again, debiting an account does not mean increasing it, and crediting an account does not mean reducing it. So, the question now is, which account do we need to debit to increase or decrease, and which account do we need to credit to increase or decrease? As we know, money does not appear or disappear magically. For money to go to one account, it has to go out from another. So there is a source and destination. So in accounting, credits are considered as the source, while debits are considered as the destination. And as we know in double entry accounting, it keeps the balance sheet balanced. So the equation assets equal equity plus liability shall remain. And equity equals to owner's equity minus any dividends distributed to shareholders plus retained earnings, which are earnings kept in the company for growth and reinvestment. Also, we can assume that retained earnings equal to revenues minus expenses. So, assets equals to liabilities plus owner's equity minus dividends plus revenues minus expenses. Let's arrange the equation a little bit to avoid negative signs so we can find that we have two sides. On the left-hand side, we have dividends plus expenses plus assets, and on the right-hand side, we have liabilities plus equities plus revenues. Do you remember that we said that credits can be considered as the source of money and debit is the destination? Look at the last equation that we have. Dividends, expenses, and assets are all destinations for the money, whether to distribute dividends to shareholders or to pay expenses or to buy a new asset using money. On the other hand, we will get this money whether from a bank, through a loan, or from owner's equity who buy the share of the company, or from revenues and sales to customer. So, we can conclude that the term on the left-hand side is debit accounts, and the term on the right-hand side is the credit accounts. So we have 6 accounts. 3 of them are debit accounts and 3 of them are credit accounts. So, for any company doing any transaction, it shall impact at least 2 of these 6 accounts. As you remember, we are using the double entry accounting principle. So each transaction shall affect 2 accounts at least. In reality, a company may identify 100 or more such accounts for its accounting system, while a large company may use many thousands. However, for bookkeeping and accounting purposes, all these 1,000 accounts or 100 accounts fall into one of the 6 categories mentioned. So don't worry if your company has thousands of accounts. All of them will ultimately fall under one of these 6 types. And once you understand them, then you can handle any type of transactions in your organization. So we have 3 balance sheet accounts or 3 balance sheet account categories: asset accounts, liabilities accounts, equity accounts. And we have 3 income statement accounts, which are revenue accounts, expenses accounts, and dividends accounts. So, let's try to make a conclusion now. As agreed, we have 6 accounts. The first 3 on the screen are the credit accounts: liabilities, equity, and revenue, which we agreed that credit will be considered as the source of money, while the other 3 accounts, dividends, expenses, and assets, are destination for the money, which are debit accounts. So, by logic now, we can understand or expect that for credit accounts, if you want to increase its value, you have to credit the account. So for the first 3 accounts, to increase or to add a value to the account balance, you have to credit it. However, for the other 3 accounts, in order to increase its value, you have to debit it because it's a debit account. And to decrease the credit account, you have to debit it. So, for a hypothetical case now, if you have more liabilities and you want to reflect that in your books, then liability is a credit account, and to increase it, you have to credit the account. However, if you are reducing part of your liability, like paying your suppliers or closing or repaying your loans to the bank, then you want to reduce the liability account, which means you have to debit the liability account. Same applies for the other 5 accounts. We will go for one example to understand it better in numbers. So, suppose for example that a company buys an asset with a value of $100,000. The firm will register an increase or a debit of $100,000 to an asset account, because we remember that asset account is a debit account. So to increase it, you have to debit it. This account could be, for instance, a factory manufacturing equipment account, because as we mentioned, the company doesn't only have one asset account, it have a lot of accounts underneath. So for an example, we will consider it here as a factory manufacturing equipment. A debit transaction increases the balance of this account because this is an asset account. Now, however, the balance sheet is temporarily out of balance until the firm makes an offsetting credit of $100,000 elsewhere in the accounting system. So, the firm has 2 options. The firm could, for instance, credit $100,000 to another asset account, reducing that account balance by $100,000. That account could be cash on hand. So, the company has a lot of asset accounts underneath this asset account category, we have the factory manufacturing account, which was increased or debited by 100,000, and on the other hand, another asset account, which is cash on hand, reduced by $100,000. So the balance sheet is balanced now. Another option, the firm can finance the purchase with a bank loan instead of the company's cash. So the offsetting 100,000 transaction could be a credit to a liability account. We know now that by taking a loan from a bank, your liabilities are increasing. And you know also from the last slide that liability is a credit account. So to increase the credit account, you have to credit it. So we're gonna credit the liabilities account by the same value, which can be, for example, a bank loan payable, which is another liability account underneath the main category of liability accounts. A credit to a liability account increases the account balance. So now we have again the balance sheet balanced by the same, because assets, which are the factory manufacturing equipment, increased with 100,000, and on the other side, liabilities increased with the same value. So if you didn't know at the beginning that liability is a credit account, you could have said by mistake that to increase it, you have to debit it by the same value, which means your actual action would have reduced it by 100,000. Then the balance would have been lost. I hope that by this example, we understand now the difference between debiting and crediting an account. We understand the different types and categories of accounts, and when do we need to credit or debit an account based on the action that we want to reflect on the books, whether it's increasing the debit account or reducing it, or increasing a credit account or reducing it. Thank you so much.